Now let us understand Unit 2, Capital Budgeting. Capital budgeting is also called as investment decision. Now what happens? You sometimes make investment. You buy a machine, you buy a new plant, you set up a factory, you modernize a current factory, you invest in technology. There are so many ways in which you can invest money. Now, when is an investment called successful? So first of all, what is an investment? So you commit your funds today. Let us say you invest 1 lakh rupees today, just for an example. You commit your current resources today. You forego your consumption of 1 lakh rupees today and get returns in future. Okay, so investment is always done to get some returns in future. Just for an example, let us say in present, what we call it as year 0, you buy a machine of rupees 1 lakh, which is going to work for, let us say, 5 years, and it will give you cash flow over next 5 years. Let us say 10,000, 50,000, 60,000, 20,000, 30,000 over next 5 years. So you invest funds today for a series of cash flow in future. This is called as capital budgeting or investment decision. Okay, so now whether to invest or not, whether to buy that plant or not, whether to start a new factory or not, whether to modernize the technology or not, these are called as capital budgeting decision. And to support your decision making, we have various techniques of capital budgeting. You can also call it as tools of capital budgeting. Now this can be divided into two parts. One is traditional and another is modern. Traditional, they do not use time value of money or non-time value of money, I am writing. And modern, they are based on concept of time value of money. We have seen in previous class, time value of money means either discounting or compounding. So traditional techniques do not use time value of money. They do not do discounting or compounding, whereas modern techniques use time value of money. Now, for the purpose of your syllabus, traditional techniques you have to study is payback period. It is also called as payback period, PBP. And second is accounting rate of return. ARR. Modern techniques you have to do, number 1, discounted payback period. DPBP. Second is net present value. This is very famous technique, NPV. Third is profitability index. PI. And fourth is internal rate of return or IRR. We will look at each one of them separately with the help of an example. Okay. Now see this example. This example was asked in previous year also. There is this company TBSM. It is planning to invest in a project that cost rupees 1 lakh. So your investment, I'm writing here, investment is equal to 1 lakh. With a life of 5 years, so this project is going to be for 5 years. No salvage value or scrap value. That is, when you dismantle the project after 5 years, you're not going to get anything in scrap. Your cash flows after tax, your CFAT, cash flow after tax, are as follows: 20,000, 35,000, 30,000, 30,000, and 20,000. And your cost of capital is 10%. This cost of capital, for now, you can consider this as an interest rate, or suppose you invest this money elsewhere, you will get return of 10%. So this is also your opportunity cost. Okay, so basically it means you have to do discounting or compounding at 10%. Okay, we will see how to do it. Okay, now you have to compute payback period, discounted payback period, NPV, IRR, and profitability index. We are going to see these methods or techniques in with the help of this example. Let us prepare a table. First is, let us start with payback period. First of all, what is payback period? So payback period is number of years it takes for project to recover investment. Years to recover investment. So if you see this example, you are investing 1 lakh. So in how many years will your 1 lakh come back? It is as simple as that. So here, how will you calculate payback period? Here, you are given cash flows for 5 years. Year 1, 2, 3, 4, 5. CFAT are given to you in example. It will be given to you in example. I am just copying it from the question. 20,000, 35,000, 30,000, 30,000, and 20,000. Okay. So you see, you are getting 20,000 in year 1, 35 in year 2, and so on. Now, how to find out payback period? What you have to do is, first of all, you have to find out cumulative cash flow after tax. So basically, you have to find out cumulative values. Cumulative of first year would be 20,000 as it is. Next year, it will be 20,000 plus 35,000. So cumulative value of second year will be 55,000. It means you have collected 20,000 in first year, 35 in second year. Total till second year you have collected 55,000. Now add value of third year, 30,000. So you will get 85,000 in third year. Now add 30,000, you will get 1,15,000 in fourth year, and add 20,000, you will get 1,35,000 by the end of year 5. Okay, it means total cash inflows. This CFAT is nothing but cash inflow. You can also call this as benefit. Okay, here your investment of 1 lakh is your cost, and CFAT is your benefit. So what we are essentially doing is we are doing cost benefit analysis. Okay, now we have found out cumulative cash flow, and see where does your investment, your remember your investment is 1 lakh. It is given in the question. Now see where does your investment of 1 lakh rupees lie in cumulative value. It lies somewhere between year 3 and 4. So how much time will it take to recover the investment? So it will take at least 3 years. So how to do this? Payback period is equal to 3 years, because in 3 years you will get 85,000. Still you have not recovered 1 lakh. So how much is left to complete 1 lakh? You have received 85,000. So still amount left is 15,000. From where did 15,000 come? 1 lakh minus 85,000. And when will you receive this 1 lakh? You will receive in year 4. So out of 30,000 of year 4, 15,000 is for basic investment. So you have to recover 15,000 from 30,000 in year 4. So your answer will be 3.5 years. So basically, you will receive your investment 1 lakh rupees in 3.5 years. You can also write payback period is equal to 3 years and 0.5 years. Instead of 0.5, you can write 0.5 into 12 is equal to 3 years and 6 months. If you want to convert it into months, otherwise 3.5 is also fine. Okay. So you will receive your investment of rupees 1 lakh in 3.5 years. Now, whether you should make this investment or not. Suppose management has a cutoff of 3 years. I'm just assuming, this is not given in the question. Okay. So your payback period is more than cutoff of 3 years. Cutoff means management does not want to take anything that takes more than 3 years. Okay. So what will you do? You will reject this proposal. Okay. Just suppose your cutoff for management is 2 years. No, not 2 years. Let us say 4 years. Cutoff for management is 4 years. That is, management takes project. If payback period is shorter than 4 years, it rejects the project which are having payback period of more than 4 years. So your payback period is less than cutoff of what management wants. So you will accept this project. Okay. So it is subjective and it depends on what management wants. If management wants cutoff to be 3 years, this project will be rejected. If management wants cutoff to be 4 years, the project will be accepted. Okay. But you have to write accept or reject of payback period only when cutoff years of management is given in the question. Otherwise, you just have to find out payback period is equal to 3.5 years and that is enough. Okay. You don't need to write anything extra. Okay. So this is one traditional technique, payback period. Now you see, in this payback period, we have not used the concept of time value of money. We have not used discounting or compounding, or we have assumed that all future cash flows have the same value. But we have seen in the previous class that time value of money exists and you cannot have same value assigned to cash flows received in different time period. So we will use something called as discounted techniques, and this is called as let us start with discounted payback period. So payback period without time value of money we have already seen. Now let us see discounted payback period where we will use time value of money. So what you have to do, first let us from the question copy the cash flows. Year and CFAT, it is given to you in question. 20,000, 35,000, 30,000, 30,000 and 20,000. Now what we have to do is we have to find out present value of this cash flow. And for finding present value of cash flows, we will use something called as present value factor. Now, if you remember in the question, we are given cost of capital is 10%. It means your discounting factor is 10% and present value factors you have to find out at 10%. Now see the financial tables, and in financial tables you see table C. where you are finding present value of lump sum of rupee 1. Now in table C, see 10% and year 1. The value is 0.909. 10% and year 2, 0.826. 10% and year 3, 0.751. 10% and year 4, 0.683. 10% and fifth year, 0.621. This is called as present value factor. Now what does this present value factor basically mean? A rupee received after year 1, what is its value today? 0.909. If a rupee is received after 2 years, what is its value today? 0.826. If a rupee is received after 5 years, what is its value today? 0.621. So if you want to find out present value of 20,000, what will you do? You will multiply it with present value factor. So you will get present value of CF80. Okay. So your answer will be 20,000 into 0.909. It will be 18,180. 35,000 into 0.826, 28,910. 30,000 into 0.751, it will be 22,530. 30,000 into 0.683, 20,490. And 20,000 into 0.621, 12,420. So you have got present value. Now you need to find out discount. So this is discounted cash flow. Now you have to find out payback period for this discounted cash flow. So first of all, find out cumulative present value. First year it will be 18,180. Now keep on adding present value of next year, 18,180 plus 28,910. So it will be 47,090. At 22,530, it will be 69,620. At 20,490, it will be 90,110. At next year's cash flow, it will be 1,02,530. And if you make total of present value, it will also be 1,02,530. Present value of all cash inflows is 1,02,530. Now let us first find out discounted payback period. Discounted payback period. So first of all, check cumulative value and see where does your investment lie. Your investment is rupees 1 lakh and it lies somewhere between year 4 and 5, between 90,110 and 1,02,530. So your discounted payback period is equal to how much time will it take to recover 1 lakh? So it will take at least 4 years and something above 4 years. Now in 4 years you have recovered 90,110. Now how much is left? The amount that is left is 1 lakh minus 90,110. It is 9890. Okay. Divided by, when will you receive this amount? You will receive this amount from present value of cash flow of year 5. So out of this 12,420, you have to recover 9890. So it will take 4.796 years to receive this investment or recover this investment. You can also write this as 4 years and 0.796 into 12 is equal to 4 years and approximately 10 months. Okay. You can leave your answer at 4.796. That is also fine. Okay. Now let us say management has a cutoff. 4 years, just supposing. Okay. This is not given in the question. So any project which is above 4 years will be rejected. So your payback period is greater than 4 years. So you will reject the project. Okay. So this is how payback period works. Okay. Now from this table itself, what you can find out is an answer for your next technique. Next technique is called as net present value or NPV. NPV is nothing but sum of all present value of cash flows or cash inflows or future value of cash inflows minus investment. So see, we have already found out CFAT multiplied with discounting factor and present value of cash flows, and we have already found the total present value of all future cash flows is 1,02,530. So present value of cash flow is 1,02,530, and investment is given to us in question. So answer is minus 1 lakh is equal to rupees 2530. Okay, this is net present value. What does net present value means? Your future value of cash inflows, that is your benefit. Value of benefit is 1,02,530. Your cost is 1 lakh. So your net benefit to your shareholders is 2530. And what will you write now? Since NPV is positive, we will accept the project. Okay. So either you have to accept the project or reject the project. It is very important to write the decision. It will be carrying marks. So suppose you find out that NPV is negative. So you will write that since the NPV of project is negative, the project is rejected. And if the NPV is positive, you have to accept the project. So you will write decision according to whatever comes, whatever NPV you find. Okay. In this case, NPV is positive, that is net benefit is positive. So you have done a cost benefit analysis. You have found that your benefit are 1 lakh 2050. Your cost is 1 lakh. Your benefits are more than cost. So you will accept this project. Okay. So you will write a conclusion that since the NPV of the project is positive, you will accept the project. Okay. Another small technique is called as profitability index or PI. This is very simple. Profitability index or PI, the formula is sum of present value of CFAT. So all the cash flows, you find present value and you make a sum divided by investment. So basically, you see in NPV, it is present value of cash flow minus investment. Here it is present value of cash flow divided by investment. So instead of minus, if you put the sign of division, it is profitability index. Now, total of present value, we have already found out 1,02,530. So present value of cash flow is 1,02,530. Investment is 1 lakh. So your answer is 1.0253, or you can write 1.03. That is also fine. You can round off. Now, how do you decide whether to go for the project or not? The rule is if PI is greater than 1, you accept the project. If PI is less than 1, you reject the project. That is, you invested rupee 1 was your cost, and your benefit is 1.02. So your benefits are more than cost, so you accept the project. Similarly, let us say in a hypothetical scenario, if your PI is, let us say, 0.9, what does it mean? It means that your project had investment of 1 and it turned out to be 0.9. You are in loss, and that is why you have to reject the project. So depending on your PI, whether your PI is greater than 1 or less than 1, you will decide whether to accept the project or reject the project. This is another technique. And one more technique called as IRR. This is called as internal rate of return. Internal rate of return. Now see, let me first explain. Now this is a graph. Here I am taking NPV, and on the x-axis I am taking interest rate or discounting factor or cost of capital R. Okay. Now you have studied NPV here. Okay. Now NPV and discounting factor, they have an inverse relationship. NPV and discounting factor. Discounting factor means rate of interest or cost of capital. They have an inverse relationship. It means if you increase the discounting rate or present value rate, your NPV will decline. Okay. Now see, if you see this graph, you see here your NPV is positive here. If you see this quadrant, your NPV is negative. Okay. So after a certain level of discounting, if your discounting factor increases by a certain amount, or if your discounting factor is too high, your NPV becomes negative. But there is a point where your NPV is equal to 0, exactly at this point. Okay, that is when your R at which NPV is equal to 0, this rate is called as IRR, internal rate of return. So basically your internal rate of return is the rate at which your NPV is equal to 0. Okay, rate which makes your NPV as 0. Okay, now see, in the previous in the same example, we had found out when discounting is done. Here see, discounting is done at 10%. You found out present value and you found out NPV 2530. Your NPV was positive and you accepted the project. Okay, so your NPV is positive. Now you need to find out IRR. You need one NPV that is positive and you need one NPV that is negative. Okay, so you already have one positive NPV. Now you need one negative NPV. Now how to find out negative NPV? You are given cash flows of 5 years. I'm just writing CF80 again. 20,000, 35,000, 20,000, 35,000, 30,000, 30,000, and 20,000. Now we had already found present value at 10%. Now NPV, I'm just writing what we had at 10%. is equal to 2530. We have already found N at 10%, 2530. Positive NPV we already have. Now we need a negative NPV. So let us find out NPV at 15%. Now from where did 15% come? So first of all, I have one positive NPV. I need one negative NPV. So to get negative NPV, what you have to do is you have to increase the discounting factor, because NPV and discounting factor have inverse relationship. If you increase the discounting factor, NPV will come to negative. Okay, but how much we don't know. So this is only on the basis of trial and error. Okay, you can take 16%, you can take 20%, you can take 13%. Okay, so till the time you get a negative NPV, you have to keep on increasing the discounting factor. Okay, so present value factor at 15%. Now see table C, 15% and year 1, 2, 3, 4, 5, and write down the factors. It is 0.870, 0.756, 0.658, 0.572, 0.497. So I am writing factors from table C. Okay. Now multiply them. You will get present value of CFAT, but at 15%. Okay. Just multiply them. 17,400, 35,000 into 0.756, 26,460, 30,000 into 0.658, 19,740, 30,000 into 0.572, 17,160, 20,000 into 497, 9940, and make a total of this. Total will be 99,700. Okay, so this is present value of all cash flows, but at 15%. Now let us find out NPV at 15%. NPV at 15% is 99,700 minus, sorry, it is not 99,000, it is 90,700 minus 1 lakh. Let me just cross check. 17. Yes, 90,700 minus 1 lakh. So answer is minus 9300 rupees. So you see NPV is, you see NPV is negative. Okay, so now you have got one positive NPV and one negative NPV. So here you have to remember two things. One is there is a lower rate. Lower rate is 10%. There is a higher rate. Higher rate is 15%. At lower rate, your NPV will be positive. NPV at 10%, we found out earlier, 2530. At 15%, NPV at 15%, we just found out, minus 9,300. So we have one positive NPV, one negative NPV. Positive NPV is at 10%, negative NPV is at 15%. So where will be IRR? So IRR will be a rate somewhere between 10% and 15%. And how do we find out this rate? What will be the internal rate of return? So formula for IRR, this is called as interpolation. Formula is lower rate plus NPV at the rate lower rate upon NPV at lower rate minus NPV at higher rate multiplied by delta R. Lower rate plus NPV at lower rate upon NPV at lower rate minus NPV at higher rate into delta R. Lower rate is 10%. For time being, we will ignore the percentage sign. NPV at lower rate is 2530 upon NPV at lower rate is 2530 minus NPV at higher rate is minus 9300 into delta R is 5%. So 10 plus 2530. This denominator will be minus minus plus. So it will be 11,830 into 5. If you solve this, you will get answer of 11.07 percentage. What does this IRR mean? IRR means that if you discount cash flows at 11.07%, your NPV will be 0. Now, what will be the accept and reject criteria here? So, how to use NPV? So, if NPV is, how to use IRR? So, if your IRR is greater than your cost of capital or discounting rate, you accept the project. Here, see, your IRR is 11.07%. Your cost of capital is 10%. That is, your returns are 11% and your cost is 10%. Your benefit is 11%. Your cost is 10%. So, you will accept the project. In a hypothetical scenario where, let us say, your IRR is less than cost of capital, just a hypothetical scenario, what will you do? You will reject. In this case, you will write down the conclusion. Since IRR, that is 11.0%, is greater than your cost of capital, that is 10%, the project should be accepted. Now, there are two things that I want to additionally focus on. This sum is over. One is cash flows. Let us say you have a project. This is a new example. With, let us say, investment of these and annual cash flow of 25,000 for 5 years and discounting rate or cost of capital is equal to 10. Only this method. That is, they have given you investment of 1 lakh, annual cash flow of 25,000. Now, if you remember, when cash flows are 25,000 for 5 years, same cash flow every year. This is an example of annuity. Okay? And cost of capital is 10%. So, how to this method? Let us say first, payback period. Find out payback period when cash flows are same. Here you don't have to find out oral calculation actually. So you invested 1 lakh and you get 25,000 every year. So what will be your payback period? It will be simple 1 lakh divided by 25,000. Here you get 25,000, you will recover 1 lakh in 4 years. It is logical. Number two, let us find out NPV. NPV at now NPV formula is present value cash flow minus value. You find capital here. So your cash flow is 25,000, but these are same cash flows for 5 years. You will use something called annuity. Like FA at R percentage, here percentage, here investment 25,000 X equal D. here 791 minus 1 lakh all 9 lakh. Reject the project because NPV is negative. NPV is done. Third is PI. PI is equal to present value of cash flow divided by investment. Present value of cash flow we have already found out anyway. 25,000 is the present value, is the cash flow. If you want to find out present value of 25,000, which is an annuity at 10% for 5 years, divided by 1 lakh. So numerator will be 25,000 into PVIFA, again table D, 10% 5 years, 3.791 upon 1 lakh. Basically, it will be 25,000 into 3.791. So 94,775 divided by 1 lakh equal to 0.95. So your PI is less than 1. Reject the project. Note down that when NPV is negative, PI is always less than 1. Okay. Now, how will you find out IRR? So, here what we already have found. We have found out NPV at 10%, we have already found, and we have found that NPV at 10% is 5225 minus 5225. Already have a negative NPV. Now we need a positive NPV. So what we will do is we will reduce the discounting factor and we will find out NPV at 5%. Let us say here, no, you have to make a table. Just find out NPV at 5% is equal to present value of cash flow minus investment. Present value of cash flow is 25,000. Since this is annuity factor, it is PVIFA at 10% for 5 years minus 1 lakh. Check table D and not 10%, sorry. This 5% for 5 years. 5% 5 years. 1 is 4.329 minus 1 lakh. 25,000 is equal to 1 lakh 1,225 minus 1 lakh. It is 8225. Now you have got one negative NPV at 10%, one positive NPV at 5%. So lower rate is 5%, higher rate is 10%. At lower rate, NPV is 8225, that is positive. At higher rate, 10%, your NPV is 5225, that is negative. And your IRR is somewhere between these two rates. Let us find out IRR is equal to lower rate plus NPV at lower rate upon NPV at lower rate minus NPV at higher rate to delta R. Lower rate is your 5%, NPV at lower rate is 8225 upon 8225 minus 522 5 into 5. So 5 plus 8 to 5 upon 1345025 is 8.06%. Okay. And since your IRR is less than your cost of capital, that is your benefit is less than cost, you will reject the proposal or reject the project. Okay. This was just an hypothetical example where all the cash flows were same. So we have done two examples with all the techniques where first we have done where cash flows were different every year, and then a small example where cash flows were same.